Hello and welcome to this episode of Nothing Ventured with me, Aarish Shah. Today in the studio with me, I had Adam Shuaib. Adam is a GP at Episode 1, the seed fund that's quietly built a data engine to spot founders before everyone else. With Afghan-Irish roots, LSE to JP Morgan, then a Cambridge PhD in machine learning, he turned that toolkit on venture, scraping GitHub, Twitter, company registers, and building behavioral models that surface grit over gloss. 40% of their latest funds leads come from that machine. Adam now leads Episode 1's AI and data-driven bets, firmly people over sectors with a healthy disdain for groupthink. In this episode, we talk about why looking for a few small signals that might move the needle works.
There's a specific small number of signals that we're looking for, and those are the ones that we will then decide to reach out to those founders on.
How making sure you don't filter out for weird is critical.
There's something fundamentally not normal about you if you're going to spend 100 hours a week for 10 years doing something that could go to zero literally in any month on that timeline.
And why alpha is always in the tail end of the distributions.
The most important data, I think, to make an assessment at the early stage is how far deviated from the mean is the market, is the product, is the founder. Because the alpha is in the tail end of the distribution.
Whether 50% of the world will be covered in data centers, and how capital is concentrating in the good funds, which are less risky.
We're in an era where the capital is concentrating in the good funds that are proven and less risky.
How Legora, NAN, and Lovable are three of the hottest recent companies, and they're all European, and why you should always ask founders for another example to get to the truth.
You can't keep the act up when they ask for a moment in your life you show determination and you give an example, and then they say, yeah, what about another moment? And what about another one?
Let's get straight into it. Hey guys, whilst I've got you for a second, I thought I would reintroduce myself. My name's Aarish. I'm the host of Nothing Ventured, the podcast where I talk to the people behind the stories that make the venture ecosystem go round. I'm also the founder of Emerge One, a consultancy that provides fractional CFO support to venture-backed tech startups from seed to Series B and beyond. If you really like this podcast, I'd appreciate it if you could rate and subscribe wherever it is that you listen. And if you want to have a chat with me about anything, do reach out on LinkedIn or Twitter. I'm always up for a chat. Right, let's get back into it. Adam, really great to have you here in the studio with me. Thank you so much for joining me. It's been a while coming, but as I was saying earlier, been following you a long time on LinkedIn. I think really interesting and slightly controversial posts. And when we're going to get into some of the detail behind that now, but for the time being, thanks for joining me.
Thank you for having me. I think you've interviewed a few of my friends, Ennis from E2VC. And obviously Joe from Smedvig. Both of them have spoken very highly, so it's an honor. Thank you.
I think that's a huge vote of confidence for me, but more so for them. They were great. Ennis, in fact, has been on twice, so really? he liked it so much he did it again. So let's jump in, right? I want to talk about kind of signal versus stalking and where that boundary, where that line sort of sits, because your system that you've built within Episode 1 tracks GitHub commits at 1 a.m. and social graphs at scale. What's useful founder signal versus like just surveillance, I guess? Where do you draw the ethical line? And practically, how do you keep a model from filtering out the weird category creating outliers that data can't explain? Because ultimately, venture especially is all about outliers, and often, the more contradictory founder and what they're building is potentially better outcome, or might lead to a better outcome. So can you give me kind of one false negative that you maybe regret and one false positive that you potentially learn from?
Sure. So there's a lot in that. Let's break that down into three different parts. So the first thing, the surveillance question, I think it's a really good question. A lot of people ask us, if what you're building is so good, why don't you turn it into a product? Why don't you sell it to a whole bunch of other funds?
Yeah.
We genuinely believe what we've built is best in class. We've yet to meet someone who hasn't said that it's very close to that point. So could it be a product? Probably. Once you enter that phase, all of a sudden you're taking data and you're sort of spraying it around left, right, and center.
You're selling it.
Yeah. And that's, what we have sits very specifically on our servers, in a secure fashion. It's not being sold to anyone. It's not being shown to anyone. Mm-hmm. But more importantly, there's a specific small number of signals that we're looking for, and those are the ones that we will then decide to reach out to those founders on. So, and if they don't meet that threshold, they never see the light of day, and the data doesn't go any further. So you mentioned GitHub, the GraphQL that allows you to access the GitHub API is completely free. Anyone can use it. It doesn't cost anything. And we're looking very specifically for obscure spikes in behavior that suggests someone is maybe not doing their day job at Meta and instead working on a business idea. You can click on anyone's GitHub profile and you can scroll down to the activity section. And if you see 72 commits to a private repo in the last week, something is probably going on. And in the US, they've been doing this for a while. I think sort of there's a fund called Pioneer run by a guy called Daniel Gross, who had an exit to Apple. Then he had his own fund with Nat Friedman, which was then bought out by Meta. And now they work for Meta on the superintelligence team. But he was doing this for a while. So it's not untrodden, like people have looked at it. But I feel like we've gotten to a point where no one has done it as sophisticated as this. So you mentioned, how do you not miss the obscure backgrounds that don't tick the obvious boxes?
How do you make sure you're not filtering out for weird?
I mean, what we did is, firstly, we interviewed 30 unicorn founders to go very deep into their background as to what actually triggered them to want to build this enormous business. Like, there's something fundamentally not normal about you if you're going to spend 100 hours a week for 10 years doing something that could go to zero literally in any month on that timeline. So we got a lot of interesting data points about people battling internal demons where their whole lives people had told them, you're not good enough, you're not capable, you'll amount to nothing. Parents telling them that they're not smart enough, or a teacher telling them that they shouldn't think about being a businessman or a businesswoman or a doctor because they don't meet the bar, or they don't work hard enough, or they don't listen, or they're belligerent or whatever. You have stories of people whose parents died, or they had a serious illness. Or one founder said, my family was Armenian. My mom and dad spent their last $500 to send me and my brother to the UK to get an education. If our business failed, we would be letting down our entire generation, and it is not an option for me.
So we had Manish Karani, I was talking to you about him just earlier on the podcast. He's now building a business called Eureta, and he did exactly that. He went out, interviewed all of these sort of unicorn founders, etc. And under the lens of what he calls hail, so hardship,
adversity, illness,
adversity, exactly. And he can now sort of graph those characteristics. He can, he can mirror those characteristics or apply those characteristics to founders or others, right? But it does seem to be that whole kind of trait of having faced adversity that seems to be that kind of chip on the shoulder, right? That great founders have.
And it's finding, I think, examples of that in a way that's not too intrusive is incredibly hard. So we interviewed these people, then we interviewed the GPs that had backed them. This is Mamoon Hamid, managing partner, Kleiner Perkins. This is GPs at Benchmark, at A16Z, at Greylock, all the large funds who have been doing this longer than anyone in Europe. And the more people we spoke to, the clearer this signal was that it wasn't because someone had studied at Stanford or worked for Google or OpenAI. Now, it took us 4 years to realize this. I think that is the caveat, right? On day one, it's like you can apply a very simple filter to the top of funnel, give 3 extra points to someone who worked for a company that's raised more than 100 million. It's very easy to do that. But we were missing a lot of companies. So we got to a point where we were able to look at these more nuanced factors in a way that didn't involve you having to be sat opposite someone. So I can look at how many countries you've lived in online without speaking to you. I can see how many languages you speak. I can see obscure hobbies.
It's bizarre. I would be the ideal founder, except I don't want to build a venture back business. 5 languages, 6 countries, and God knows what else. But
well, there you go. But these things, are available. And it helps us look at things that most other VCs wouldn't in a first pass. And our false negative rate has been getting lower and lower over time.
Excellent. And so, I mean, if you were to think, like so it sounds like in the early days, you may have had some of those sort of false negatives or 100%. False positives. So what are good examples of those?
Yeah, sure. So, we have a score. There's like a complex scoring mechanism, which is 0 to 100, which is the AI. And then there's a less complex one, which is a bit more deterministic. It sort of objectively takes in someone's background and assigns a preordained scoring system for certain factors. Why do we do that? It's just much cheaper because you don't have to pass thousands and thousands of people through the model. And I remember the first time we built this was probably 2021, so almost 5 years ago.
Wow.
And Matty from 11 Labs came through. And they had already raised the pre-seed, so that is sort of my solace in that. It had already gone.
Yeah.
But the
So
maximum.
you didn't miss him. It had already
Correct.
It already happened. Yeah, sure.
But the 11 Labs founders are a bit more traditional. I think they're ex Palantir and ex Google. But he came through with a score of 6 when the maximum was like 20, and 6 is normally the cutoff for what we would or wouldn't look at. So there was a lot of learning from that in terms of who should or shouldn't score highly. But what was really interesting is that the people at the very top of that scoring system had such an obvious background that every single other VC would also be chasing those leads.
Right.
So either when you reach out to the founder, they're speaking to 50 other VCs, or they've already raised before. The interesting signal was those people actually just on the boundary, because the boundary means you have enough interesting qualities to get some sort of score,
but haven't gone.
Precisely. And actually the irony was the alpha was in those people who are in the middle of the distribution.
Not the obvious ones that everyone's talking to. It's the ones that people, which ultimately I guess, makes sense, because either you're going to have to be super competitive in competitive rounds with potentially people with bigger checks and bigger brands.
For sure.
Whereas if you're looking at that kind of at that boundary founder where maybe he or she is maybe being passed on because doesn't quite have X pedigree or hasn't ticked Y box.
For sure.
From your perspective, that's a more interesting conversation. And actually, so this is the other part of this whole thing, and you and I talked about this, I think, when we first spoke. Presumably, though, you still have humans in the loop with all of this, right? Because I guess the concern, and it's not really a concern, but, if you get to a point where essentially your system is making those investment decisions, then there is something very human about the weirdness, right? Like, I guess there is something that systems can't pick up, right? There's signals that are very much about sitting across a room from a founder and just seeing how they react to X, Y, or Z circumstance, which you can't necessarily pick up from data that is readily available. So presumably you keep humans in the loop throughout the process, or at the end of the process. Like, how does that work?
Sure. So the top of funnel, because we're first round investors and the pre-seed and seed boundaries become very blurred, and do we call ourselves a seed fund or a pre-seed fund? The debate is still
You're just
ongoing.
Early stage fund.
But the first institutional money is how we see ourselves. And the systems that we've built will flag about 400 people who are definitely founders and probably 400 other people, of which maybe 10% are founders.
Got it.
So there's a very big top of funnel. You cannot reach out to everyone. So you need to be quite selective with the 5% that you can actually meet, right? What we do is we will choose those people using the model. It will help. It can give everyone a score. Once we have that score, every single thing after that point is done by the human.
Got it.
Because a company could get a score of 100. The algo could say, this is the best company in Europe right now. If I can't get that person to answer my message and then schedule a call and listen to me and meet the rest of my partners, we can't. It just doesn't happen. This is a people business.
Yeah.
This is not click the buy stock or sell stock button the way it is in public markets.
Yeah. So one other question, and we'll move on from this, but I do find it like fascinating. And of course you have, when I've seen your posts about this on LinkedIn, you get a lot of pushback from people specifically around this whole point about, well, are you extracting the kind of human element out of it? And it sounds like you're not. But do you think that this has also led to you seeing more deals, right? So if you think about average VC, 3,000 decks a year or whatever, 300 a month, whatever the metrics are you therefore able to pass through more decks and or more founders than you otherwise think you would have?
So I think our friends at Seed Camp probably see more decks than any other VC in Europe.
Yeah, sure.
And they have a button that allows you to upload a deck and someone at the company will review it.
Yeah.
And it will be tens of thousands, I think, a year they probably receive.
That's a lot of decks, yeah.
They probably invest in, I think, 1 or 2 or 3. It's not a large number, I think, from the cold inbounds. But those 2 or 3 could end up being the ones that return the fund.
Yeah.
So in our second fund, we talked about Lawhive. That's doing very well.
Yeah, sure.
We know for a fact that they did send their deck to many other VCs via this submit your deck button. And they received a huge amount of no's because it was not an obvious market. It wasn't an obvious founder necessarily. Yeah. And it wasn't an obvious sort of business model.
Yeah.
But Hector from our team met them and he loved them.
Yeah.
And
Hector Mason.
Yeah. So you have to be against the herd and you have to go against the herd to really find those companies that can be generational. and I met someone who used to work at Point9, who doesn't work there anymore. And he said internally, this is one of the best seed funds historically in Europe. They have amazing returns for many years. The very best companies on the whole that they invested in were ones that split the room, where half the IC loved it and half the IC hated it. Yeah. And that bifurcation, I think, is incredibly important in the job that we do.
That's almost a signal that you do want, right? Like
exactly.
Because if either everyone's a firm no, then it's an obvious, right? But if everyone's a really firm yes, then you've got to question yourself as to whether you are actually feeding into some sort of biases inherent in either the founder or the business model or whatever, right? Like, and especially today where, everything is now AI, right? Like, as in, if all the hot rounds are AI, do you then get trapped in this sort of, well, it's AI, therefore we should, if on paper it looks good, but actually are you missing something else that may be either tangential, or another business that may be tangential, but actually has a better chance? Because otherwise, if you're only investing in kind of the AI businesses that are coming across your desk, then you run the risk of essentially that market becoming overly saturated and no one wins, right? Sure. Or there's very, very few clear winners. I think it's super interesting. And do you are you constantly refining? Again, super intrigued by this, but are you going to continue to refine the model? Like, how do you see that progressing over time?
So the most important data, I think, to make an assessment at the early stage is how far deviated from the mean is the market, is the product, and is the founder. Yeah. Because the alpha is in the tail ends of the distribution, right? At least when it comes to sort of founder persona and behavior. And no model in the world is really going to assess that at scale for you. Yeah. And even if it could, you would have to gather the data by yourself by interviewing these people in person. Yeah. So the next shift for us is, how do you use the data to get the right people in the room, but also there are a small number of in-person questions that we want to narrow that sort of process down to, where I can ask you 3 questions, and after those 3 questions, that will give me all the data points I need to know if I'm going to progress you or not. Yeah. What are those 3 questions? That is sort of the secret sauce that, you're not going to keep that the secret sauce. The founders will tell everyone the questions you asked. But the key data points you probably cannot gather without having someone in the room. And that's how we're progressing. So how do you adapt this hybrid model where there is the pure data-driven stuff and also the human, let's say, enrichment of that data? Yeah. So that's the direction we're moving.
And I think, and I'm fairly sure that as the technology progresses, I can see even that becoming viable one way or the other, right? Whether that's looking at non-verbal signals, whether that is looking at sort of inflection in speech and tone of voice. Like, there's all sorts of subtle kind of things that I could think of that probably would work. I'm going to shift tack a little bit because, again, as I say, I think we could talk about this particular topic for a while. I want to talk about AI, like, at the moment, right? Because it's hot, as we just said, but the unit economics really aren't. And now we're seeing this kind of robberous situation with NVIDIA investing in companies that they'll buy their compute, et cetera, et cetera. But if compute is essentially the new rent, right? That's essentially the cost of selling AI. What is the path to kind of 70, 80% gross margins when you're doing, I don't know, 1 to 3 million, 1 to 5 million ARR at a seed stage kind of AI native seed company, right? Who is capturing that value over the next 3 to 5 years? Is it the models? Is it infrastructure? Is it apps? And what essentially gets killed off once that GPU subsidy ends, right? Because essentially that's kind of where we're at the moment, right? So, and where are founders fooling themselves, whether that's context window costs, RAG sprawl, eval theater, and what would it take to convince you to wire a seed check today for an AI native seed?
Yes. So I think the thing about the compute side is, yes, the hyperscalers are putting what was supposed to be 40 billion, 50 billion, 80, 100 billion dollars a year each into this build out of data centers and compute. Yeah. And NVIDIA benefited massively, $5 trillion company. There's plenty more wind, in the sails of that business. There's a lot more juice in the lemon. Like, I wouldn't be surprised if that hits $10 billion status in the next 2 years
10
or 3
trillion.
years.
Yeah.
So 10 trillion, sorry. Yeah. And if you look at the current architecture of these language models and generative models, you're taking something that's really, to some degree, been around since 2017, particularly on the text-based language side. the Google paper, attention is all you need, 2017
Yep.
paper.
Yeah.
And you can scale up the size of that, but the core logic is still fairly similar. And at some point you hit an asymptote where you cannot get more performance out of that structure. So people can talk about hallucinations and how with the right tweaks and the right data and the right guardrails, you can minimize that. But ultimately that is a feature of what you've built, because it's taking a bunch of text and telling you what you want to hear to maximize a reward model. Like that's fundamentally how that language model works.
Yeah, it's why ChatGPT is so nice to me
Well,
when it shouldn't
exactly.
be, right?
Yeah, for sure.
Yeah.
And you can have gigantic data centers and put more and more data in, and you can have data labelers in, you know, third world countries, which is what many of these businesses do to generate data that doesn't exist on the internet, because now you've trained on the entire internet already. You know, OpenAI ran out of data, so they started transcribing every YouTube video on YouTube or, you know, podcasts on Spotify to get any data they can, right? Eventually, you hit an asymptote where all these models look exactly the same. There's no differentiation between them. And who wins? On the consumer side, it's the person with the distribution channel. Yeah. That's always how consumers work. It's like when everyone is using your product, you can add additional features. You can start, you know, giving them the ability to buy off of Amazon, which is what GPT are doing now.
Or you can price out your competitors.
Yeah,
you know,
for sure.
a period or whatever.
So like this will go to zero ultimately, in the same way that when it came to search, like we don't pay for search because we are the product, right? Google sells our data and serves us the ads that some of us click on. And it will not be long before you open up your GPT and there will be a sponsored ad, click here to buy your new, you know, coffee machine from, you know, Temu or whatever it is. Like, we're not going to pay for GPT. I think the pro product will be free because it has to be. But that distribution channel means they can serve us ads. That is the way it will go on the consumer side.
Yeah.
The thing about the compute is at some point there needs to be another breakthrough. So how do you go beyond the architecture that's already been here for 8 years?
Sure.
How do you have something completely new that can actually take us to AGI?
So this is potentially stuff like edge compute. So, you know, Elon's now talking about using Teslas to essentially, you know, run massive models via idle compute, you know, when Tesla's sitting parked or whatever it is. And obviously there are mobile phones, et cetera, that, you know, potentially there is the ability to do that. Is that what you're talking about? Is that the direction that potentially?
So, like, ultimately, what these are complicated neural networks, and a neural network in digital form is replicating to some degree, to some order of approximation, what's happening in your brain. Yeah. So, you know, whatever the human brain has, some people say it's anywhere from like 100 million to sort of 10 billion neurons, depending on how you look at it, right? Yeah. And if you want something that's much more advanced in a human brain, it needs to be much bigger. But just putting these neurons, which is sort of a simple mathematical function, you take in a bunch of data, add it up, and output one number. And if you stack all of those in a row, you can approximate any nonlinear function. Like that's the geeky mathematical way of how that all works. But the current structure clearly is to some degree replicating the brain, but not exactly. And is it just replicating or regurgitating the data that it's heard, or is it actually thinking? And most people would say that it's probably not actually thinking. How do you have a brand new structure that actually properly mimics the brain in a way that it is thinking? How do you get there? It's going to be huge amounts of data and huge amounts of compute. So NVIDIA will still be the winner because nobody can do what they can do. And that breakthrough will need huge amounts of energy and power and compute. Yeah.
And given that it does or will require huge amounts of data, energy, and compute, is there a pathway to get there?
I mean, yeah, Sam Altman had this joke where he's like, you know, in 50 years' time, is half the world covered in data centers? Yeah. It's hard to see how that is not a future, right? And that's quite terrifying in some ways. It's already started, right? Are you going to get there without some sort of fusion breakthrough on the energy side? Sure. Probably not, because these things require enormous amounts of power. But people are, you know, directing enormous resource to having even a tiny edge over their competitors, where Google can spend 80 billion. NVIDIA, you know, are willing to sell them the chips, and then Meta will come along and say, we want to do 100 billion. At what point does that stop? I mean, these guys are sitting on enormous amounts of idle cash. They don't know what to do with it. So they found a use for it. And no one wants to lose.
Yeah, I mean, this is the thing. I mean, I think, you know, what we've seen again with NVIDIA over the last, you know, month, essentially, they've just gone on this like massive spree, right? Like exactly to your point, they're taking all bets from everyone, right?
Sure.
Like they are not, you know, they're not looking to back a winner. They're looking to back everyone, because I think exactly to your point, like if this plays out the way you were suggesting, and probably that is, you know, that is the correct sort of thought process. You know, it's the equivalent of Chrome versus Safari versus Microsoft Edge or whatever, right? Like if all of these guys have a zero cost platform, then it doesn't matter whether NVIDIA has backed one over the other. They're all equal. They're all fair game, right? So I think, yeah, I mean, for someone like me who is, you know, not probably non-technical, but can see kind of some of these pathways, some of this stuff happening. You know, the question that keeps coming across my mind, or kept coming across my mind, I should say, is who is going to have enough cash to just keep this going? But to your point, it feels like everyone has enough cash to keep this going, and there is enough cash to keep it going.
At some point, the buck has to stop with someone, right? The record is going to stop playing, because there is an infinite resource that comes to an end at some point.
Yeah,
I think more importantly, people are willing to back multiple horses because the true winner is not yet clear.
Yeah.
And what does it even mean to be a true winner?
Yeah.
Like OpenAI could win on the consumer side.
Yeah.
But there's a whole business angle to it, and a business use case for these technologies is very different to what you and I would use it for at home on a Sunday evening when we're bored.
Yeah.
Right. People will say that if you look at the numbers, OpenAI will probably be the winner.
Yeah.
They have the best engineers from a consumer, certainly, and they have, you know, Sam Altman. You know, he's not an engineer, but he is a genius when it comes to knowing how to raise money and run a company. Like, he's pretty good, I think.
That's been proven by now.
Yeah, exactly. So they're a $500 billion company. That was the latest secondary valuation. They will be $1 trillion. They can't not be $1 trillion company.
Yeah.
But yeah, is there only one winner in this market? Probably. It's hard pressed to see there not just being one winner.
Yeah, I mean, look, and again, you know, this is all future casting. Maybe the company you mentioned could give us the probabilities, right? But I mean, the reality, I think, you know, the thing that, I mean, with my CFO brain on, you know, it has always been the reason that OpenAI has been able to achieve what it's been able to achieve is because it is, you know, at the unit economics level, losing money hand over fist, right? So the question always then becomes, how do you make that model work? And exactly as you say, it can't happen because you can't scale without the compute. That is a fixed cost, or a linear cost to scaling. Unlike most software businesses, where actually you have, you know, diminishing or economies of scale, essentially, you know, as you scale. So the cost of compute per user or per whatever unit will decline, whereas with AI it can only increase, and the cost of that compute doesn't look like that's going to drop significantly in the near future.
It's unlikely to, but I think what might happen is when this arms race slows down, and it will eventually, if OpenAI have marginally the best product and they have the distribution network where all the consumers are using them, they know that if they slow down slightly on the spend, they will probably still be number one. So if you combine that with the fact that they can start selling ads, you might actually get to a point where you're profitable quite quickly. But you also have the classic, you know, startup mindset of the moment you stop, someone does catch up. Yeah. And if Sam Altman is paranoid, he's not going to stop because he wants to get to AGI, whatever that means, before anyone else.
Yeah.
So.
Well, let's not talk about AGI because that's like an hour-long podcast in itself. So let's switch tack a little bit, because again, this is something you and I were talking about a bit earlier, actually. This is the whole kind of future of VC, the kind of barbell VC future, if I could put it that way. Like, who is going to fund the middle? Because mega funds are getting bigger, right? Very clearly. Micro funds are scrappy and they're able to raise, and of course they're raising far less money. But the mid-tier is getting squeezed, right? Just as we were saying, what are we underestimating in London? Does seed underwriting shift to more $200 to $300 million outcomes, which is what I'm hearing for a lot of VCs at the moment, right? Or are we still going to double down on decacorns and accept, you know, longer hold times, essentially? And how do you think Episode 1's, you know, new fund 4 will adapt to that kind of new paradigm?
So I think you've had this interesting development of the ecosystem where the funds that had winners probably started off in the 0 to 100 range, let's say. And when you have winners, you have good returns. you've been building your LP base slowly in the background. All of a sudden, you can go from 100 million to a 400 or 500 million fund.
Yeah.
I think Cherry Ventures and Corandum have done this very well. They've had some great winners. They're exceptionally smart. They have a fantastic LP base that they've been building for many, many years. And they've sort of, let's say, gapped up into that next tier of the market. And the funds that can't do that will struggle to raise, because we're in an era where the capital is concentrating in the good funds that are proven and less risky. And you also have this weird dynamic where for some of those funds in the middle, you don't have this generational aspect that a Sequoia or a General Catalyst has, where it will always be there. There's a much more existential risk for the businesses in the middle, where they were started probably by people in their 40s and 50s, and they're coming to the end of their careers. And you either have the next people in line to hand it over to,
some sort of succession.
And which is very difficult to do, and we've navigated that reasonably well, I would say, so far. But if you can find someone to hand it over to, what happens? Those people will leave. What are they going to do? If you've been a GP, you don't want to go work for someone else. You need to be your own person now. So you're going to set up your own small fund. And you've had this barbell strategy where you've had a lot more solo GPs and emerging managers in the 0 to 25 range. And then the successful funds are getting bigger and bigger and bigger. So it is very hard to be in the middle, because you're too big to do 500K follower checks, and you're too small to battle Sequoia for a 10 million seed round that's super hot.
Or even go later, right? Like you just don't have the capital.
It's really difficult.
Or the ability to do that. On the point of the portfolio, like of the companies you're then backing and betting on, does it become a more sensible strategy to move away from, or without moving away from the kind of power law aspect, right? So obviously, you're always going to be looking for the unicorns, the decacorns, etc. But is there a use case for VC where actually, if we're seeing $100 to $500 million outcomes, we should actively pursue those?
So there's an order of magnitude difference almost between what the entry valuations can look like.
Yeah, sure.
So what I mean by that is our tech lets us get there very, very early. So there are deals that we can do which are 1 at 5 or 1.5 at 7.5. If I want to make 20 times my money, that can be 150 exit, assuming no dilution.
Yeah, sure.
If you're doing a 10 million seed round at 50 million posts,
it's hard.
Now you need a 1 billion exit, not a 150 million.
Yeah.
So that's a 1.5 round versus a 10 round. In an absolute fashion, that doesn't sound like a huge delta, but look at what the implied valuation is, and then the multiple that you need to make, and that scales very rapidly. So you have this order of magnitude difference.
Yeah.
So for us, I mean, the maths of venture will never really change, I think. The question is, are there enough truly generational businesses to actually realize that power law and have a 10x or 20x fund?
So let's answer that question from a European perspective, because this is one of my favorite topics, to be honest, on this podcast. Like, do we have those generational businesses in Europe? I think, well, there's a couple of things I would say, right? So we do to an extent, but we also don't, because a lot of them move to the US because that's where A, the deep capital pools are, but B, that's where the exits are. That's where the companies with the balance sheets that can acquire them are. That's where the IPO market is. And we keep losing them. But then the second order effect of that is that the capital that is then released to the founders, to their employees, and potentially to those later stage investors who are predominantly US and pension funds and all the rest of it, the capital stays overseas and doesn't get recycled back into this market. So we kind of had this doom loop where we're neither creating or we're neither keeping the generational businesses here, UK, Europe, and the capital's also going elsewhere. And the obvious one at the moment is Revolut. You've had founder move to Dubai, to save whatever it is, $3 billion in tax potentially. But that's $15 billion exit, but he's going to be sitting in the UAE, not in the UK.
So I think historically that probably was true. I think what gives me hope is that the market for venture, many VCs, many LPs probably saw it as US and Europe as being two very segmented, non-homogeneous regions. I don't think that's the case anymore. So 3 of the hottest deals, I think, in the market over the last year, one was Lagora, which is a Swedish company. One was N8N, which is a German company, and then Lovable, which is a Swedish company. And those were all done by US funds, right? I think it's happened quite quickly, but a lot of the exciting companies that US funds have been doing are increasingly European. And I think once you take the region seriously, there's a lot more cash that follows. And, we've seen that at the A round. We've also seen that at the earlier rounds as well, where these funds are willing to do, 5 or 10 million seed rounds because they have the capital and the talent is there in Europe. It's begun to change now. I think the pendulum is swinging in the right direction. Has it swung far enough? No. But ultimately, what has happened historically isn't necessarily a signal for what's to come. Sure. I'm still super, super bullish on Europe. And a lot of these funds used to make the founders actually move to the US if they did the round. That's not happening as often now because the engineering costs are way, way lower in Europe. If you can. Well,
this is my, and again, I don't want to get into doom loop because there's too much to get doomerish over, but the way I've been describing it recently is that the UK certainly, and maybe Europe more generally, is starting to look like kind of the Bangalore for US, right? When you can hire an engineer for 3x less than you can in the US, like that arbitrage is super simple. You set up your business in the US, but you set up your operations in the UK or Europe. Do we run the risk of underpricing our talent here to the extent that, where they're not also seeing great founders, because they've earned good money and have the balance sheet, the personal balance sheet to be able to go out and kind of take some risk. Are we potentially, are we stifling that a little bit?
There's many factors, but ultimately you assume that in a reasonably efficient market, any arbitrage will be sort of arbitraged away.
At some point.
And you have some top engineers will move from Europe to SF where they know they can get 4x the salary. But then you have the issue, with Trump's visas where it's harder to get in. So many, if you look at OpenAI, like something like half of their world-class engineers are of European origin.
Interesting.
That's not accidental. There's signal there. And if those people from France or Germany or Eastern Europe decide to stay in those countries or move to a European hub instead of SF, because now there's US VC money in these regions, the rounds are bigger, they can afford to pay people more. This will all balance out, and I think it's already balancing out.
Interesting. Well, that's positive, and I hope you're right, because I personally think that, you think about the research coming out of the UK and Europe, like we have some of the most talented research. The thing that actually gives me some comfort is, the stuff that we're seeing, from a client perspective is all tending towards the kind of very, very deep tech, life sciences, hardware, space tech. It's all in hard tech, right? Like it's all in industries that are, harder than turning a spreadsheet into a bit of code, right? Sort of thing, right? Which I think Europe has a massive advantage as far as that's concerned. And therefore, if we get things right in terms of making sure that, both the funding ecosystem, but also the talent pipeline and all of those things are kind of kept strong, then I definitely do think that Europe has like a massive opportunity ahead of it. And, as I was saying, I use N8N daily. It's probably, for me, certainly has been one of the most transformational tools for my own business, just because I've just been able to do stuff that previously I wouldn't have been able to do, right? Or wouldn't have been able to do particularly easily. I hadn't even thought about the fact that it's a European business, right? But if we're seeing those sort of companies coming out of Europe, and continue to see those sort of companies being built and coming out of Europe, then I think there's a massive opportunity.
But I think what people don't realize is a lot of these rounds are hype rounds that create what we call a unicorn, right? I think in a period of 3 or 4 years, one of my colleagues, Millen, was telling me like 80% of the on-paper unicorns were created in a 2 or 3 year period. Which is outrageous.
When everything was in a bubble. Sure.
And it's very easy to grab headlines when you announce that after 2 years of founding the company, you're going to raise 150 million at a 2 billion valuation. And all the headlines are out there. People assume you're serious because you have real money. Clients trust you. It's easier to get that through procurement at your large enterprise X, and the whole thing becomes an anointing the winner flywheel.
Sure.
And the VCs know that, and that's why they're willing to pay 200x, your revenue multiple to get into that.
It's deal. Signal, right? Like I had this conversation with someone who was in PR. on the podcast because I asked, I said, to an extent, the kind of TechCrunch headlines almost do a disservice, right? And his take was, well, you may say that, and maybe some of the articles that get written are maybe journalistically a little bit light, but in a world where you don't have a huge amount of signal, as a seed stage or an early stage business, that hype is the signal, right? Like that is part of the signal. The question is whether the question is whether a VC takes the signal for what it is and discounts it or whatever. It's whether the market, like the wider market and the consumer market, whether that's business or consumers, takes it for what it is. And it's also whether the founder takes it for what it is, right? Because I think the trap is also to believe that hype, right? So, and there have been multiple, as you know, stories of, paper unicorns that have then just deflated completely and, founders have been left with nothing. So I think it's navigating that in a way that, to your point, yes, that flywheel hopefully generates some momentum that then allows them to reach sort of breakout velocity.
Right.
Versus allowing it to essentially be a nail in their own coffin because they can never live up. I mean, it's the same as when companies do get overvalued and then founders really, really struggle to hit those valuations, which then in future rounds leads to real problems, like if they can even raise at all.
Well, I mean, the buck keeps getting passed forward, and that's the ironic nature of this game, right? Where I can do a round and then someone else will do the next round and then there's another round after that, and it becomes this stacked deck of cards. And at some point that whole house can come down. The question is, does that come down when it's still private, in which case the VCs take the hit? Or does it actually get acquired by a public company, and in which case, if that project doesn't work, it's the public investors that take a hit? But ultimately a lot of people are going to lose money in this because it is a bubble. That bubble will burst at some point. The question is who is holding the bag?
Who's holding the bag?
When it comes down.
Yeah. I mean, which is the private equity question as well at the moment. But again, that's yet another story. Let's finish off with a kind of going back to kind of that human element, right? So people over sectors, without necessarily fetishizing kind of grit, right? So you've built models around determination, chips on shoulders, inner demons. How do you measure that without rewarding trauma cosplay, right? Or biasing to loud extroverts? How do you deal with that? It is very difficult.
What I would say is this concept is one that I think the best investors have understood deep down in their minds, but perhaps haven't vocalized it enough to actually almost rationalize it to themselves, if that makes sense. And a lot of the people I've spoken to, like, we've actually been able to get in front of them via cold email, not even warm intro.
Wow.
And the reason why someone who receives 1,000 emails a day will respond to your cold email is because there's something different there. So I was actually quite surprised. I thought this would be very obvious and that no one would want to speak to us, but the reverse was true. It's picked up steam a lot recently. I think one key catalyst was actually Ferhat from Hummingbird and Barron and some of the other partners at Hummingbird. They did an article with The Generalist, and that was the first time that I became aware of them and this potential strategy of looking at the founder behavior as being the signal. I think in some ways they let the cat out of the bag. And I wonder if they perhaps regretted doing that interview. I'm sure they got a lot of LP interest, but also a lot of copycat funds. And their concept was trauma. And I think there's something in that, but it's one element of a much more complex procedure. And we've been trying to fill in more of those gaps where it's not just damaged founders. It's people who have quirky personality traits or do, weird things for fun, or are not afraid to take extreme risk, or, are incredibly optimistic no matter what life throws at them. Like, many of those things have signal, but they are not a byproduct of traumatized children.
Sure. But I think this is the point, right? If you look at someone like me, I potentially tick a lot of those boxes. Right. But as I said, at a personal level, I'm not interested in building a venture scale business for a number of reasons. One is which I've just never found a problem that is so deep that I want to solve it, at least for the time being. Other than actually what I really would like to solve is all the really shitty financial modeling, AI generated financial modeling stuff out there, because it really does suck. But to that point, right? Like, I would tick your boxes. You may come to me But actually, at what point would I fail? Like, obviously, if I sat there and said, well, actually, I don't want to build a VC-backed business, then obviously I'm going to fail.
Sure.
But if I came into that and sort of try to blag my way through, how do you discern the sincerity from the kind of wannabes?
It comes down to pattern recognition.
Sure.
I think if you've met 1,000 founders over 10 years, I think you have your own mental map of what good looks like.
Sure.
And as you said, you can on paper write down 5 characteristics that a VC wants to hear. That's very different spending 4 or 5 hours in person with someone over 3 meetings and dinner, where they're looking at your micro behaviors, and you can't keep the act up when they ask for a moment in your life you show determination and you give an example, and then they say, yeah, what about another moment? And what about another one? And this is a great book called Talent, which is written by Daniel Gross and a professor at a university in the US, where they are writing down their framework for what it means to hire someone or invest in someone with talent. What does talent mean? And they have these list of questions that are fairly obscure, but they said a very easy way to see through the noise is when someone gives an example, ask them for a second example or a third example. And if it's not bullshit, people will always have more that they can give. If it's fabricated, if it's purely a sales point that's not real, they will very quickly falter and stumble when pushed a bit harder.
That's super interesting. So that's the kind of, it's the 5 whys sort of framework, right? Like just keep digging until you get to the actual truth, right?
For sure.
I mean, yeah. And I could imagine that there are lots of people out there who probably would stumble after the first example, but I can imagine lots of people who probably have multiple. I'm just trying to think how many I would have, but we'll take that offline. Look, I want to finish up with a couple of questions that I ask all of the guests that come on here, right? And I'm actually thinking about killing off the first one because we tend to find people don't really have an answer for it. But what is one thing that you have a contrarian opinion about from any area of your life, whether that's work, politics, socially, or at home?
So there's a few things, but I think what one comes to mind, just to keep it venture focused, I think is that most VCs, most venture funds probably shouldn't be in business. And if you look at the numbers, so there's something like $250 billion a year that's going into US venture, just to sort of condense the world a bit. And if you want a 12% IRR on that over, let's say, a 7-year horizon, just to average across, let's say, early stage and A and B funds, you need to create about $1.5 trillion of exit value if you assume 2/3 of that business is owned by investors by the time it sort of goes public. There is not $1.5 trillion of exit value being created globally. Figma, a huge success this year, that was, it's settled somewhere between 40 and 60 billion. Are you creating 25 Figmas a year?
Exactly.
So what happens is there will be a small number of funds that will do well. There will be a massive part of that distribution where LPs will realize very poor returns.
Well, which is shown in the data anyway, right? Like where I think it is, median returns are sort of 1.4x, there or thereabouts. But actually, the majority of funds don't even return 1x, right? Like I mean, and many of them don't even track the S&P, right? Like performance is not great. And that comes down to sort of incentives to some extent, right? Because the one lesson that I learned, and it was Hussein from Hoxton that taught me this lesson, which is the business of VC is to make money, like first and foremost, not necessarily to invest in innovation. I'm paraphrasing a lot, and that certainly isn't what he would say sort of explicitly. But I think his the point is that what I think a lot of people don't understand, founders especially don't necessarily understand, is when you raise a venture fund, you have to live. How do you live? You live off the management fees that charge. Thereafter, everything is cream. Now, obviously, if you want to raise a second fund, you do need to show performance, right? But there are a swathe of managers who are really managers rather than venture capitalists who get into the game because, okay, this is I have the network where I can raise the funds. I can then charge my management fee, and actually, performance is not mandatory, if I can put it that way. But I guess the flip side of that is the more funds that you have out there, potentially the more opportunity you have, for really some incredible founders to be found. to your earlier point around 11 Labs, right? So Concept and Reece Chowdhury, were in the pre-seed. What an incredible outcome for them, and have gone on to raise, their second fund, which is I can't remember now whether it was half a. No, it's 500.
60 or 80 million. 60, somewhere.
Yeah. So it was okay. Sorry. Yeah. So, but that was like from an at the time an unknown fund, right? So I guess having more funds hopefully leads to some outcomes that you wouldn't have otherwise had. But then the flip side of that is there's a lot of cash that potentially gets left by the wayside. And the second question, so that we can get to know the real you. Although I think we've probably got a good idea already. What is something that moves you emotionally?
So I think in this line of work, it's very, very hard to find a work-life balance. I think it's impossible to be able to turn that switch off, because this is not a 9-to-5 job. You're raising money and investing and entertaining people, and you're, the point of reference for a founder who's put his entire life into something. And if it's not working and he wants to call someone at 1 a.m. on a Saturday morning, that person is probably you. And it's intoxicating and it's exciting. And when you're at a certain level of seniority, like it doesn't feel like work, and this job doesn't feel like work to me. To be able to turn that off and actually say that your family means more to you, and your wife or your partner or your husband or your kids, and finding the ability to spend time with them when actually, the thought of chasing the next unicorn is maybe significantly more exciting. It's very hard to do that. I've met very, very, very few people who can do that well. And I think that is, if you can do that, it's special, where you can have both. But in this job, I do think it's quite hard to have both, because you have to be on 24 hours a day, 7 days a week to succeed.
So you don't have time for emotion.
Well, I think a lot of people, most very good world-class venture capitalists, it is their life. There's nothing outside of the job.
Yeah.
And I think people who find the space to do both, I think it's very special.
Amazing. Adam, it's been an absolute pleasure having you here in the studio with me.
Thank you for having me.
For the audience, where can they find you online? You're on LinkedIn, on Twitter. Where can they find you on the internet?
Yes, LinkedIn is good. I share some of our insights, some of our data-driven points, giving away a lot of the secret sauce, I think. Hopefully not shouting into an echo chamber. So yeah, LinkedIn is the best place.
Amazing. Well, look, thank you so much for joining me. It has been an absolute pleasure having you in the studio today.
Until next time, thank you for having me.